In this video, we're going to talk about why your business should have a dividend policy. I know that sounds like an exciting topic, but really when you think about it as a business owner, there's nothing better than getting a dividend because that is money in your pocket. I want to talk to you about my origins or my thinking around a dividend policy in comparison to a business that, say, the owners treat the money in the bank account like a personal bank account, putting all sorts of stuff through that business bank account. I remember early in my accounting days, I noticed that there was a very close correlation between success and discipline. And discipline in this case was around business owners that treated the money in the business bank account separate to their personal finances. I found that the businesses that really thrived, they left that money in the business and then took amounts out on a predetermined and disciplined fashion, as opposed to the businesses that weren't as successful, tended to take money out on a more ad hoc. Oh, I've got to pay for the groceries, I've got to pick up a birthday gift, I've got to pick up for that. And you see all these different elements going through the business bank account. To be clear, they weren't claiming these items as expenses. They were claiming them as personal drawings, but it was in a very haphazard fashion. So my thoughts very early on in my professional journey were influenced by seeing people who were disciplined and successful were also disciplined in the way that they rewarded themselves from the business, as opposed to businesses that treated the money in the bank account like their personal bank account. There's a key underlying reason why they were able to do that, aside from business success, which we'll touch on in a moment, regarding how they paid themselves as well. We've also noticed a shift in recent years for more and more requirements around a dividend policy. Firstly, in Australia in particular, the tax office really wants to kill off any entity that isn't an individual. Now that would be scary if they wanted to kill off individuals. Isn't a self-managed super fund or isn't a company. They want to have just those three entities. They're far easier to tax, it's far easier a regime. But over the years, there's businesses that run as partnerships, that run as trusts. So when I say dividend, yes, that is a term for a company, but you can also apply this if you are running a trust, if you are running a partnership. The second reason for that is ownership groups are getting broader. To begin with, it might be one or two people owning either 100% or 50-50 of the business, but now ownership groups are getting larger, which means you have more fragmented ownerships. It's not as clean as 100% or 50-50. And you can't have every single person putting their grocery bill through the business, through the drawings. There's an element of practicality that does become an issue. The part that you probably inferred from the first section of this video around the businesses that were disciplined and successful, they were running their business like a disciplined commercial enterprise, even though they may have been the sole owners of the business. Why were they able to pay for their groceries and life expenses without having to dip into the business bank account? Well, firstly, they were paying themselves a commercially appropriate wage to begin with. And I think that's a crucial part in your journey as a business. Understandably, when you start out in business, you're not going to be able to pay yourself the full rate for what you do. But when you reach a certain stage, if you're doing a role that you would pay someone else $180,000 a year for, well, you should be paying yourself $180,000 a year for. So firstly, there's the commercial operations being true commercial operations. What you're paying yourself is what you would pay somebody else to fulfill that role. That then opens you up to the opportunity of having a really commercial, disciplined approach around your dividends. And that's where I want to jump into the mechanics of paying a dividend in your business. There's three elements to this. Firstly, there's the timing of payments or the frequency of the payment. Number two, there's the quantum of the payment. This is most likely the part you're going to have to spend the most time on to articulate and to understand what the quantum of that dividend is going to be. And then lastly, the discipline around this. First and foremost, timing of a dividend payment. This is quite straightforward. Personally, I'm a fan of either quarterly payments or 6 monthly payments. Firstly, it's very hard to fake good performance over a quarterly or 6 month period, number one. And number two, you look at what a listed company does with dividends. More often than not, they are paying an interim dividend, so a 6 monthly dividend, and an end of year dividend. You can do the same within your business, but I personally am okay with quarterly as well for a privately run business. Reasons why I'm not really for a monthly dividend payment is because of the reasons around calculating the quantum. Is monthly can lead to too many variations. You could have an amazing month, you can have a terrible month. But as I said, for a quarter or for a 6-month period, it's often a very fair reflection of how your business is going. Whereas if you wait a whole year, that's often not enough time to keep you motivated. It's too much time. You're going to be working and waiting for this payment that at some point is going to come, but might not come for an extended period of time. So step number 1, define the frequency of your payments, and ideally that's on a quarterly or 6-monthly basis. The next part is the quantum of the dividend, and ideally this is linked to a percentage of earnings. For example, if we earned $100 in the period and we said we're going to pay 40% of that as a dividend, well then quite simply the dividend is $40 and then it'll be split amongst all the shareholders in proportion to their shareholdings. Very simple. But the question is, what is the right percentage? Let me give you a couple of examples. In a mature business, if you look at one that's relatively consistent in its approach and also one that has been around for quite an extended period of time, 20 to 40% of earnings is often a good starting point for a dividend. And if you look at what listed companies do, that is quite often around about what they're paying out. But there are some subtle things that you need to consider when looking at your dividend policy. Firstly, what is the money going to be used for in your business if you were to keep it in the business? For most, if not all business owners, the ultimate return that they're ever going to get and the biggest return they're ever going to get is from running their business. So if you can keep more money in the business and still get a greater return, well then you're better off actually keeping the money in the business so long as your personal needs are being covered and you as a shareholder group are happy with this. 2 classic examples of this are Warren Buffett with Berkshire Hathaway. That company under his leadership has never declared a dividend. Never. So the only way that you could realize any money from Berkshire Hathaway if you bought shares when he first took over would be through selling shares. Now those shares have appreciated incredibly significantly, and that's the biggest understatement of all time, over that period of time. But he made a decision that, hey, shareholders, you're better off keeping your money in here because I'm going to get you a better return than if I was to give it back to you. A more recent example of this is Amazon. Amazon have done the exact same thing as well. So that's point number 1. What do you need to keep in your business to achieve its financial goals? If you're a business that relies on stock, that relies on work in progress, that relies on having to pay for things in advance, it's probably going to be more challenging for you to pay dividends than it would be for a business that, say, is running a professional services business where the only expense you really have is your wages and your debtors pay you on a very consistent basis. It's going to be far easier for that second business to declare a dividend than the first business. Or the second business, the professional services business, may find it easier to declare a far higher percentage dividend than, say, a manufacturer or a construction business or a distribution business as well. You also need to consider the opportunity cost, not just of the potential lost earnings or lost returns by taking money out of the business, but also what are your alternatives? Your business might have a relatively high amount of debt and you go, look, I'd rather pay the debt off than pay the dividend. I also know some people who want to pay a dividend yet maintain the debt. There's no right or wrong answer, so long as you're not compromising the financial health of your business. And the third and final part is if you look at your budget and your financial planning over a 6-12-month period, you should be able to project out with your CFO what dividends you could realistically pay out. So you almost reverse engineer what the amount you're going to pay is if you achieve your financial goals, but at the same time still covering all your operational requirements like buying stock, like covering your tax repayments and different obligations your business might have. Most importantly though, whatever you set out from those predetermined elements, whether you keep the money in the business, how you calculate how much you're going to pay out, is when you actually get to the payment, you actually physically need to pay it. You need to make sure that that dividend amount goes out. What we don't want to ever have happen with clients is 2 things. Number 1, they declare a dividend, but they actually can't afford to physically pay it out. If that's the case, then we made a mistake around the calculations we did originally. Or, this is even worse, asking owners to inject money back into the business after declaring a dividend. That is incredibly demoralizing for very obvious reasons. It would be a pretty hard conversation to have with your spouse and go, oh, we've got $50,000, and then all of a sudden go, oh, I need to get 10,000 of that back and give it back to the business. Those are conversations we want to avoid. So if we do our planning correctly, you can have a very effective dividend policy for your business. And the last component is discipline. In my mind, there's two layers of discipline. Firstly, review the dividend policy probably every 6, if not every 12 months. Make sure that it is in line with your business's vision and goals for its shareholders and also for its operations. But I'd like to think the vision and goals for its shareholders are also going to be the same goals in a privately owned business as what it will be for its operations. So there should be a really strong correlation and consistency between those two elements. And the other side is pay it. You still need to pay it. I know a client who a few years ago did their first round of dividend payments, and the amount that he got paid, he goes, I don't need this money. I said, but that's the calculation. That was the amount that you're entitled to for the business's performance for the last 6 months. So you're getting that money. Now, the tax accountant had structured everything so it was done in a tax effective manner, regardless of how little or how large the dividend was. And I recommend you get that same advice from your tax accountant. Ultimately though, that dividend was something the business could afford. And even though that gentleman thought it was way too much, that was what the calculation was, and that's what he got. And to overemphasize that story, do you think multi-billionaires need dividends that are over $1 billion? I would know for a fact that Bill Gates and Steve Ballmer, their Microsoft dividend, each time they receive a dividend is over $1 billion in cash. Now, do they need it? Of course not. But they've earned it. They own that shareholding. If Microsoft pays out a dividend from its earnings and they own a certain percentage of the shares, they're going to get that cash in the bank. Same thing with your business. So stay disciplined to it. And even if it's only $50, that dividend needs to be paid. Hope you found this video useful and you set that process up, if you haven't already, in your shareholder agreement.